Hello, thank you for tuning in. In this video, I'm going to teach you how to calculate the operating returns and help you to find out whether a company is able to find awesome deals. Okay, so let us start out by writing operating returns. So, just to make sure that all of our viewers understand what a return is, let us start from there. So what is a return? So let us do an example for better understanding. Right? Say you invest in a stock. Right? Say you invest in a stock. Everyone knows what a stock is. So say you invest in a stock and we'll just do that. We'll assume that you buy it at year 1 and sell it at year 2. So we'll get data for that. So we have the price, we have the shares, and we have the value, total value that we have invested. Okay, so this stock has the price of $10 and you end up buying 100 shares. So you have invested about $1,000. Cool. So you invested $1,000 and after 1 year has passed, the stock is right now at $11. So you still have, sorry about that, 100 shares. It should be 100 shares. So you still have 100 shares and it ends up being $1,100. Okay, so what happened here? So in the span of 1 year, you were able to get a return of about 10%, right? 1,100 minus 1,000 is 100. So how much is 100 part of 1,000? It is 10%. So you got a return of 10%. So right now your trading account or investing account has 1,100 as a balance. So what are then operating returns? We saw what a return is in a stock market perspective. So what are operating returns? So these are returns that a company gets from operating activities. An example of an operating activity is like any construction projects, right? Like a real estate construction company is planning to construct a building and sell it eventually to some buyers. Like a mall or some sort of that, or commercial buildings. So they have to create these construction projects. So what happens is if there is a very good working management, they'll be able to reduce their costs and get a better deal, right? They'll be able to get a better deal and increase the returns for their shareholders. Okay, so let us start with the first ratio, which is the return on equity, which is equal to the net income, which is equal to net income divided by the total book value of equity. Net income, we have net income divided by the total book value of equity. Okay, so we get the book value of equity from the balance sheet and we get the net income data from the income statement, the bottom line. And so let us just create a sample company. This doesn't really exist, so let us just create a simple company right now. Let's call it as let us call the company. So let us call it as QRS Corporation, Corp for short. So let us write a few data. Right, this is not any specific financial statement. I've just gathered the data and put it on this piece of paper. So it's all multiples of millions. So total assets is about 30 million and total liabilities, it's about, let's say, 10 million. And we have the book value of equity. If you calculate it, which is 30 minus 10 is 20 million. So let us also just add the net income over here. So I have basically gathered all the necessary data that we'll be working with. Okay. Net income is about 2 million. Okay, so let us just write this. It is for the year ended in 2018. So by the end of 2018, we have this much assets, this much liability, this much equity, and this much income. Okay, so let us make an example out of this. Let us calculate the return on equity. So we have $2 divided by $20. $2 worth of net income divided by $2 worth, $20 worth of book value of equity. Remember, those are all multiples of millions. So which gives us a 10% return. Cool, right? So what does that basically mean, a 10% return, right? That means for every $1 of the book value of equity, you get a 10% increase, right? You have to understand that the net income contributes to the development of the equity base, the book value of equity of the company. How does the book value of equity of a company grow? It grows because you keep on adding the retained earnings towards that. So sometimes, yes, we retain some of the earnings from net income, and sometimes we pay dividends. So we have to understand the net income contributes to the increases in the book value of equity. So that is why we calculate what a return on equity is. What there is a serious thing to consider and acknowledge, you could say a downfall in this is that the return on equity is quite sensitive to leverage. Because the equity calculation is equal to the assets minus liability, there's liability which is leverage. So let us say the liabilities is equal to 20 million. It has increased from 10 million to 20 million and the assets remain the same. Then the equity has come down to about $10 million. So right now what we have, let us try and create the return on equity ratio. We have about 20% return. Now you might be thinking, hey, that is an awesome return. I'm very happy for that 20% return. So you have to just acknowledge that this return has been only possible due to an increase from borrowing the money. Not always will this be good for a company. Borrowing money must be done with caution. Okay, so let's go to the second ratio, which is called the return on assets, which is equal to the net income divided by the total assets. So we get the total assets from the balance sheet and we get the net income from the income statement's bottom line. So what does the return on assets tell us? It tells us that how efficiently is a company or corporation able to use their assets very well to create this net income. Okay, so if you remember, we did something called the sales divided by total assets, and this is a little bit different because the bottom line net income is way smaller than sales. The net income is what we are able to keep, and so therefore this becomes a much important ratio than that. So let me give an example where we have 2 million divided by 30 million, which is about 6.67%. So $2 million in net income and $30 million from the total assets. We have a 6.67%. So what is this sensitive to? So this ratio is sensitive to the working capital. So what is the working capital? So working capital is equal to the current assets minus the current liabilities. So in a very good firm, this has to be a positive number. Okay, so it's the short-term cash the company has. So let's assume that the current assets go up. That means it is also contributing to the total assets. Current assets is a subset of the total assets. When it increases, the total asset increases. So let's say the total assets has increased to $35 million and the total liability has also increased to about $15 million. But this will leave us with the same $20 million in equity. So the return on equity in this scenario does not change. It remains the same 10%, but the return on assets changes to 5.714%. So that's the return we get. The return is a little bit lower than the previous return. So this tells us, okay, this is sensitive to the working capital. So okay, you're telling me, okay, it'll give me a ratio that is not sensitive to many things. So before that, let us note that if, right, in these two ratios, if the QRS Corp had no liabilities, what would happen? Right? If they had no liabilities, the return on equity would be equal to the return on assets. So think about that. Okay. Let us go on to the third ratio, which is the return on invested capital. This is the most important of all the three, which will help you to determine the capabilities of the management. So this is equal to earnings before interest and taxes minus the tax payable. So we have written EBIT times the tax rate, that is basically tax payable. So you have removed the tax part in the EBIT, so it's like EBI now. So we divide that by the book value of equity plus the net debt. You might be asking, why do we use net debt here and we are using book value of equity? Because we're only using the capital that we have used to invest in projects. So net debt is equal to, if you remember, it is equal to total debt minus excessive cash or savings that we're not using in any projects. So we only want in this equation the capital that is invested in the project. Cool. So we have the return on invested capital. Okay. So let us give an example right now and say that the EBIT is equal to $3 million, earnings before interest and taxes, and the tax rate right now is about 30%. Not bad. And we have about net debt, which is equal to about, let's say, $8. So let us calculate the return on invested capital right now. We have 3 minus 3 times 0.30, that part is the tax payable, so we reduce the taxes and we eventually divide it by 20 plus 8, which is 28, and we end up with a number which is equal to, let me get this right, which is equal to 7.5% return. Okay, that is very cool. So you might be thinking right now, the money, right? We have borrowed the money and it occurs an interest expense. That is why we just leave the interest expense there. Okay, so why not use net income, right? Because the net income, the problem with that is that it is the bottom line in an income statement, which means we have already pulled out the interest expense. Because we have borrowed the money, right? We need to acknowledge that we have to spend some interest expense to take over and complete this project. So these are all the things about the operating returns that will help you to know whether a management is awesome or not. Thank you for watching this video till the end. If you liked the video, please feel free to subscribe and check out our website. Have a nice time. Bye bye.